A big market correction last week pulled down gold to its worst drop since November. Friend of Kitco, Ronald-Peter Stoeferle, fund manager and research at Incrementum AG, and also author of the annual In Gold We Trust report, is going to guide us. Ronald, great to have you back.
Michael, good to see you. Happy New Year.
Thank you very much. It was the last time we saw you. I saw you in Frankfurt. That was in November, and a lot has happened since that time. Ronald, we're going to get into metals, but first, give us a snapshot of what's happening with the Fed and the general markets.
Well, from my point of view, we've seen peak hawkishness. Somebody tweeted out today that I think Bank of America now expects 7 rate hikes this year, and I replied, well, I'll be happy to bet against that. From my point of view, and I'm really quite vocal about it, it will be the shortest and the shallowest rate hike cycle in the history of the Federal Reserve. Now, why do I believe that? First of all, household ownership of equities at the moment is 45 trillion. That's higher than ever. That's actually twice the size of the US economy. And we already see how angry the stock market and how nervous the stock market is regarding this new hawkishness that Jay Powell found. So from my point of view, it is truly the stock market that dictates US monetary policy. And therefore, I don't believe that we will see so many rate hikes. I don't believe that we will see a significant amount of quantitative tightening. And I think, Michael, to be honest, that gold is already sniffing out the policy arrow. So gold already kind of tells us that at some point, at this point will be probably quite soon, and sooner than the market expects, that the Federal Reserve will have to make a U-turn.
We want to get to gold and your gold call, which is quite bullish. But how many rate hikes do you think we're going to be in for this year, Ronald?
Perhaps it might be a one and done. Why? I think we saw it in 1997 and also in 2016 when the market expected a big hiking cycle, and then it turned out to be very, very slow. From my point of view, inflation numbers, due to the base effect and so on, they will start to come down over the next couple of months. And I think this will give the Federal Reserve some leeway to say, well, okay, we don't have to become that aggressive. Inflation numbers are coming down, so we can actually take a little bit more time with our rate hike campaign. And then I think if you have a look at the yield curve, which is obviously the most reliable recession indicator out there, it's already telling us, well, the economy is not doing so well. We're seeing the GDP now indicator by the Atlanta Fed expecting basically zero growth for the first quarter. We're at some sort of a borderline recession already. So the Federal Reserve wants to hike into a weakening economy. It wants to hike into a weakening stock market. And I just don't think that this is going to happen. As I've said, household ownership of equities, 45 trillion. We will see if equities go down even more. I think we will see an immediate effect on consumer sentiment, on investments. So therefore, I cannot emphasize it enough. I think the market is expecting so much hawkishness from the Federal Reserve. It is ridiculous.
A couple of weeks ago, there was a lot of people that were predicting that inflation was just going to gallop. I was surprised in your call there, Ronald, that you see that it could actually be coming back down. Why the change?
Well, from my point of view, first of all, I think Jay Powell now also realized that inflation is not transitory, but that doesn't mean that it will keep rising all the time into hyperinflation. From my point of view, it is also to a large degree a psychological process. And I think, if you talk to people over here in Europe, and I think it's pretty similar in North America and all all over the globe, inflation is a topic again. We're seeing it with our heating bills. We're seeing it with every restaurant visit. We're seeing it, of course, when it comes to real estate, building prices. We're seeing it all over. And I think, and this has always been our case, a wage price spiral will really start spinning. So this will be the next stage of this inflation story, and therefore I don't think it's gonna be a transitory, but that doesn't necessarily mean that inflation numbers cannot come down. I think this will happen over the next couple of months, and I think what's really crucial for the market and especially for gold investors is obviously inflation expectations 1 year out from now and perhaps 2 years out from now. Inflation is being seen as some sort of a concern, but inflation expectations over the long term, they're still pretty much anchored, and I think as soon as also the long-term inflation expectations realize that we will have to accommodate to higher inflation numbers over the long term, I think this will be the big moment for gold. But we're not there yet. And I think over the next couple of months, I think inflation numbers will come down, but then at some point, probably in the second half of the year, they will start rising again, and then this will put the central banks in an even more peculiar situation, probably.
In your recent note, you had some bold contrarian predictions for the year ahead. I want to go through them. Gold marks a new all-time high in 2022, Ronald.
Yeah, well, I mean, I think that everybody hates gold at the moment. I had a look at the price forecasts from most of the big banks, and they are all pretty bearish. Then we are seeing that the many market participants were quite frustrated with the performance of gold last year. 2021, where inflation really became a topic, and so I think many threw in the towel. In our recent piece, which was called "Why Gold Has Lost Its Mojo," we explained what the reasons were for this disappointing performance of gold. And I think first of all, it was the fact that gold did so well in 2019 and 2020. Then, of course, it was the strength in the US dollar. It was the fact that equity markets last year, I mean, the S&P made, I think, 17 new all-time highs with very, very low volatility. So we saw major opportunity costs coming from the equity market. Then, of course, Bitcoin kind of stole the show. And most importantly, from my point of view, long-term inflation expectations, as I said before. So that was the main reason. I think this is slowly changing now. And, let's face it, we're now trading at 1,800, so $250 below the all-time highs. We're seeing lots of pessimism, I would say peak bearishness when it comes to gold. And that's a pretty good setup. And I think what most people fear in the market is, well, now we are seeing the big rate hike cycle, and this will be the end for gold. Well, if we look back into the history books, 2016, when Janet Yellen raised interest rates, this was exactly the day of the first rate hike. This was exactly the day of the low in gold. Pretty similar in 1999 when Alan Greenspan started hiking again. 3 weeks after, gold made its low. So I think this is really sell the rumor, buy the fact. So I don't really fear the rate hikes, because gold is already anticipating this policy error that has happened basically already before. Therefore, I think once we see the first rate hike, and it's going to happen in March, there's no doubt about it, then I think that should be the point in time when gold really starts going up again.
It's an odd sector, Ronald. You talk to the gold speculators, and as you said, it's bearish. But if you talk to producers, they say, well, It's a pretty good gold price right now. You emphasize also in your note regarding predictions, and then that's getting back to your inflation story, and that's looking at old energy commodities. You have oil at 110 and you have uranium over 60.
Yeah, I mean, I think when it comes to oil, having a look at the CPF function on Bloomberg, for example, which shows the consensus view on the oil market. Well, everybody is still kind of expecting significantly lower prices or a sideways move, and nobody is really expecting a big spike in oil. Now, having a look at the supply-demand picture, having a look at the capex cycle, having a look at the geopolitical situation at the moment. From my point of view, oil is still showing a very, very interesting risk-reward ratio at the moment. So we can easily go to new all-time highs, and the inflation-adjusted all-time high would be significantly higher. So I think there's still quite a lot of leeway. Of course, that will probably go hand in hand with a recession. There's no doubt about that. But I think spare capacity is significantly lower than the market sees. So I think oil is a pretty that's a pretty much of a high conviction call for me. And just to give you an example, I think in the third quarter of 2021 there was only one stock that Warren Buffett bought, and it was Chevron. And I think the fact that so many institutional investors are simply not able or not allowed anymore to buy into fossil fuels, that also prepares a pretty interesting investment case for us. And the second story, uranium, that's from my point of view a very, very simple supply-demand case. We are running one of the very, very few uranium funds out there. It was actually the best performing resource fund last year. And actually, we're seeing some sort of a renaissance of nuclear power worldwide, especially over here in Europe. I think if you have a look at the supply-demand picture of uranium, it's a very, very easy call. It's still a tiny industry. We know what's being planned in China, but also in India, and now even over here in Europe. So I think uranium is a pretty interesting setup at the moment. Yeah. So it's also a high conviction call that we have.
Lastly, Ronald, you're one of those households that is in the equity market. You're probably loaded up with tech. And what would be your warning to those people?
Well, actually, we're not loaded up with tech in our wealth.
I was meaning the households generally that we're talking about out there. Yeah. Sorry to lie. Okay.
No, but I think when it comes to the tech sector, obviously we all know that basically the majority of all the performance for U.S. equities came from only a handful of names. We all know that. We went into 2022 with the largest forward PE discount for emerging markets relative to US equities ever, and it's mainly driven by the tech space. Of course, we saw some turmoil, some volatility in this space, but it's still not cheap at all. So I would be very cautious in the tech space. From my point of view, we're seeing Tesla pretty bearish, and that doesn't necessarily mean that it will go bankrupt or whatever. But we saw a correction of 50%. I think that Elon Musk might step down this year because of some legal issues. That's one of our bold predictions that we made. So every year we make those 10 predictions, but there's an 11th one this year, as you perhaps have seen. And this call was pretty easy because we are forecasting that Austria will not win the World Cup. So if I'm wrong on all the other 10, at least I've got one right.
Also, look out for Canada, who I believe has been tearing it up right now with the recent win over US. Ronald-Peter, thank you very much for talking with Kitco.
Thank you very much. It's always a pleasure. All the best. Take care.
He's Ronald-Peter Stoeferle, fund manager and research at Incrementum AG, and look for his annual In Gold We Trust report. My name's Michael McRae, and you are watching Kitco.